Hello, everyone, and welcome to this webinar. My name is Mihir Therodkar, and with me today is James Harwood, who is the Portfolio Manager for the Russell Investments Low Carbon Global Shares Fund. Thank you for your time today, James. James will be talking about not only the strategy of this fund, but recent market developments, market dynamics, and some outlook commentary. Before I hand it over to James, I'd like to just make a couple of reminders. The first is that the Russell Investments team is going to be launching the second carbon management paper. In this article, we will be looking at carbon management strategies and implementation techniques and comparing and contrasting the pros and cons of each. This will be relevant to any investor who is concerned or interested in managing the carbon exposure of their equities portfolio. We also have a conference next week on next Wednesday at 3:15, in which James and I will be talking in the seminar about ESG and greenwashing as a whole. So if you are interested in this topic, do tune in to that. Without further ado, I'd like to hand it over to James, who will be talking about the Low Carbon Fund.
Thanks, Mihir. So today I'm going to spend the next 10 to 15 minutes, firstly talking about the economy and what's been happening in markets over the last 6 months or so. Mihir had mentioned that a lot of my recent updates on the fund have been quite similar, so I'm trying to adopt a different format. So it'll be markets, then a look at value versus growth, and then a closer look at what that means for the fund and how it's performed over the last quarter. So I'm aware that a lot of you will have seen the GOF presentation by my colleagues, and you've certainly heard that the economy has been rebounding very strongly. I think it's fair to say that the vaccine announcements back in November really drove a lot of the change for global equity markets and really set us into this rebound cycle. So we're now really early cycle in the economic growth phase. There's been a huge amount of stimulus from governments around the world, and we're also getting new stimulus packages announced, like the Biden infrastructure package that's been announced over the last week, which is expected to give further kind of stimulus to economic growth. So you can see, in the US, we're expecting returns of 7% plus from the economy this year. In our markets, we've been less affected by COVID, so we'd expect Australia and New Zealand to see lower economic growth. But that said, it still appears we're rebounding nicely from the pandemic, and that has really changed the dynamic of markets, which has been around for some time. What we started to see is the return of value investing. Value stocks have outperformed significantly particularly since the vaccine announcement, and that's had some implications for global equity funds and this fund as well in particular. So this is a nice chart. It was actually used in the GOF presentation, but I thought it was really good, so I wanted to use it in my talk. I'll start on the left, which looks at the different factors that we look at as portfolio managers at Russell Investments, and you can see there that the blue bars represent the more recent performance since the 1st of September, and the orange or the beige bars at the start of 2020 up until the end of August. So there's a marked difference in the styles that have delivered the best returns. Clearly, in the middle there, you can see how value underperformed in that first period and then has significantly outperformed thereafter. And that's it. There's also been a move from large cap or the mega caps into small caps. So that's another theme, not really as relevant for the Low Carbon Global Shares Fund, but certainly a dynamic that we've seen in global markets. If we turn to the right-hand side and the sector performance, This is something that sector weight is something that I manage very carefully in the low carbon global shares fund. Again, you can see there's been a marked difference in performance, and it's really driven by the move from growth to value. So the biggest returns in the more recent period from 1 September have been from financials and also energy. Financials is an overweight for the fund, whereas energy is an underweight, given that there's a lot of carbon within the energy names, and that's a risk that we look to manage in the way we build the portfolio. So turning to the style positioning of the low carbon global shares fund. Now, this isn't something that we actively manage per se, like our active funds, where we look to make clear bets around value versus growth, for example. What you can see here is that the low carbon global shares fund is marginally underweight value, and that's really coming from that underweight to energy. Back at middle of last year, energy had performed terribly for a number of years, and what we've seen since the announcement of the pandemic is some of those energy names really start to bounce from very kind of cheap levels, and that's a risk that we look to manage through the way we build the portfolio. But there's always going to be some form of a bias within the fund as well, given the carbon metrics that we need to hit on the portfolio side. We're naturally marginally overweight growth as well. I actually spoke and published a piece in the Financial Review in Australia, looking at ESG funds and really the strong performance that a lot of these ESG funds have delivered prior to this value rebound. And really, a lot of the ESG style funds have a growth bias. They tend to be underweight, the fossil fuel kind of names, and very, very overweight some of the names like Tesla, the real growthy type names. And that's really giving that growth bias. The numbers here are very small, in fact. So whilst the bars might look like there's some big style risks in the fund, the reality is that there's not really, because the numbers are very small, and those Z scores are within minus 0.05. So it's really quite small style risk relative to what you would see in an active global shares fund. Those of you that have dialed in to listen to my previous presentations will have heard me talk to this slide before. I think it's a really good slide because it really just highlights the 5 kind of key factors within the strategy. In the middle there is the exclusions within the fund. So that will include things like tobacco. We have a coal exclusion, also controversial weapons, which I know is something that's required in New Zealand, and they amount to around 3 to 4% of the fund. Now, in this last quarter, that detracted. Some of the coal names had a strong rebound, and also tobacco, because tobacco is a value part of the market, that also had a bit of a rebound as well. So that middle exclusion factor cost us a few basis points. If I move to the left, these are the negative tilts in the strategy. So around carbon, there's carbon reserves, which are those companies that own oil, gas, and coal assets that are still in the ground and yet to be mined. And then we also tilt away from the carbon footprint of a company as well. So carbon, because of energy names and also materials names like Glencore, some of those big commodity type names also had strong rebounds in Q1. So the carbon tilt detracted from performance a little. I'd probably highlight the carbon reserves as the key one, really, because companies like ExxonMobil that have carbon reserves have got to really oversold levels, and Exxon delivered a return of over 30% in Q1, and we're underweight, so that did cost performance. Lastly, I'll just turn to the positive tilts in the strategy. So we tilt to both green energy and ESG scores. The ESG scores are our proprietary scoring methodology. Sounding a little boring, but both of these factors marginally cost performance again. As I say, the Q1 was really all about the move from growth to value, and some of those really oversold names mean reverting somewhat during the quarter. So some of the stocks that had delivered us the best returns over 2020 did detract in Q1. So I've got some more details on that in the next slide. The next two slides, I should say. Quickly on the fund performance versus the objectives that were on the previous slide. This hasn't really changed since the last update. So you can see here that we're reducing carbon emissions by 61% versus the benchmark. We're reducing carbon reserves by 70%. And then on the positive side, we've got a better green energy exposure of 25% versus the benchmark, and the ESG score is 4% higher. So if we turn to performance, I think it's important to note here that clearly the dynamics of the market in Q1 didn't favor this strategy. Equally, the way we build the portfolio, an important part of the objective of this fund is to have or to capture the index returns of the benchmark, which is the ACWI ex Australia index. So whilst there was a lot of headwinds for the strategy from energy stocks rebounding and some of those, some mean reversion in some of the more green energy and ESG focused names, you can see here that the underperformance was only 39 basis points for the quarter, and that's really by design. This is a low tracking error fund to the benchmark. Most investors in the fund have put their money from passive style assets into a fund that's got low tracking error, but very desirable characteristics from both carbon and also on green energy and ESG scores. So we're using those positive tilts in the strategy to position for the energy transition. So whilst things haven't gone, it's not been supportive for the strategy in Q1. It doesn't mean that you've got huge underperformance like you might see sometimes in an active fund, and that's really because the tracking error of the fund is so low. And you can see here, realized tracking error over 1 year has been 49 basis points and 54 basis points since inception. So it's a very consistent fund. It's kind of what you see is what you get, and you don't really get those nasty surprises of underperformance or big underperformance. The underperformance we saw in Q1 is very explainable. Some key kind of stats. You can see that energy was the biggest detractor at 17 basis points. Materials were also, the commodity type names bouncing like Glencore that I mentioned, detracted 16 basis points. And then some of those positive tilts, you might remember the names Neste and Ørsted from previous presentations. Both of those are very kind of renewable focused securities. They detracted. There was some mean reversion in Q1, and Neste delivered a minus 25% return, and Ørsted was just under 20% down for the quarter. I think it's worth also saying, whilst we're here, that things have changed already in Q2. The fund has recouped about 25% of that performance already, and we are starting to see some of this mean reversion kind of go back again, and the underperformance that we saw from Neste, for example, has been partially reversed in Q2 to date. So it's it's something that we're bound to see through time. Some of these carbon sectors rallying very strongly, but we still believe strongly that this is a fund well positioned for the future. And maybe just finishing there on financials, there's been, particularly in Australia, actually, financials have been quite a poor performer, but they've been a really strong performer as those bond yields have started to increase, given the expectation of a rebounding economy, and that's good for financials. Even so, our overweight only added 3 basis points because we manage these sector differences versus the index very, very closely. So with that, I was going to turn back to Mihir to see if there are any questions.
Thanks, James. Yes, we have seen some questions rolling through, which we will answer now. If anyone else has any other questions, please feel free to ask them down below on the window. The first question, you mentioned a green energy ratio tilt for the fund. Is this a static or slow moving tilt, or is this something that we can expect to slowly creep higher over time?
Yeah, look, it's a good question. And Ørsted is a great example of that, actually. So that's a Danish utility company that's 7 years ago was heavily reliant on fossil fuels and has transitioned to wind energy and renewables. I was actually meeting a manager this week in Sydney who referenced just how a company like that has changed over the last 7 years, and you may have seen a lot of changes in AGL at AGL, which is the biggest utility provider here in New South Wales. So New South Wales is a utility that produces most of its power from coal-fired power stations, but it's very much going to have to change its business model over the next decade. So I think as a rule, we would expect all utility companies, particularly those that are using fossil fuels, to produce more and more of the power from renewable sources, and consequently, you will start to see those green energy ratios increase over time. That would mean that we will still be tilting to those companies with the highest green energy ratios, but I think it's given net zero objectives from countries around the world. Electricity power production is a big part of emissions, and consequently, a lot of utility companies are going to need to adapt to use more renewable sources for their power.
Thank you, James. Another question, can you please speak to the interplay between the fund's goals on higher green energy ratios and higher ESG scores? Namely, do any of these goals constrain one another?
I don't think they constrain one another at all, to be honest. I mean, there are 2 factors that we look at. So we're looking to improve both of them, both of the fund's exposure to those metrics versus the benchmark. What you often do see is companies with high green energy ratios also have high material ESG scores. That said, the green energy ratio is really focused on the utility sector, which is 2 to 3% of the market, so it's a small part of the market. Whereas the material ESG score is something that we use for all of the companies in the benchmark. So I think it's there's definitely some correlation between the 2 scores in the utility sector, but I think more importantly, the reason we're using the material ESG score is to make sure that the fund has better ESG characteristics across the board than the benchmark.
Cool, thank you. I have a couple of questions here regarding subsectors within the fund. The first is around real estate. Could you please speak to how the real estate sector and low carbon interact? Namely, are there any issues around concrete production and use within the sector?
Yeah, I think I'd answer that in 2 ways. So, so real estate securities or REITs, that's often office buildings or shopping centres. We found that, well, particularly speaking from Australia, but often REITs in that sector are quite good at positioning and using renewable sources for the future. So, whilst they've obviously been built from concrete, etc., then their consumption of power and how those buildings have been designed particularly the newer ones, is often really quite good from a renewables perspective. I think we're probably leading the way in Australia. I know it's not such a big sector in New Zealand. On the concrete side of things, that would then, you're almost then going into more of the construction part of the market, or industrials. So without doubt, concrete production is a big emitter of carbon. I don't think there's necessarily companies that just focus on, say, office buildings, etc. But you are really focusing on the carbon and the ESG characteristics of individual construction companies. So that's how, so James Hardie in Australia would be an example, and we're looking at the metrics of those individual construction companies, both on carbon emissions and also material ESG scores. Is one way that we can determine which of the companies we want to have exposure to. So it'll be a combination of how efficient are they on carbon metrics, and also the score on material ESG scores.
Cool, thank you, James. And the last question is around emerging markets as a subsector. Would you please be able to speak to how emerging markets fits into the portfolio? Namely, as a subsector, does it have higher carbon exposure or lower? And if so, is the fund inherently underweight emerging markets?
Yep. So firstly, the MSCI emerging markets, or maybe the MSCI ACWI is made up of the MSCI World and the MSCI emerging markets. MSCI emerging markets in aggregate does have a higher carbon footprint than the developed markets MSCI World. It's fair, it's a reasonably significant. It's about an additional 50% higher than developed markets. In terms of how we manage the exposure, one thing I didn't mention there in the presentation on the US was, whilst from an active perspective, we're expecting US equities to underperform. The way the fund is managed, because we have such tight controls around sectors and country exposure, we have a plus or minus 20 basis point exposure to the US market and all other country markets as well. We apply the same controls for emerging markets. So to answer your question, yes, the fund is marginally underweight emerging markets, but it's marginal. It's something that we manage at each rebalance. We look to have a plus or minus 20 basis point exposure to emerging markets in aggregate, and it is certain parts of EM that have that carbon exposure. China does have a lot of companies that emit a lot of emissions. So it's something that can be managed as well. But we're always looking to have close to benchmark exposure to emerging markets, and we really regard the region as just like it's another country in a way. So it's something that's closely managed in the way we build the portfolio.
Cool. Thank you, James. Appreciate your time on this call and appreciate all your insights around this fund. And to all our listeners, thank you for joining in this webinar. We hope it has been informative.
Thanks, Mahir.